Assalamu alaikum friends, welcome to question number 19 of SBR from your revision kit Kaplan, and this is also a question of December 2018. This is your question number 2 in December 2018 where we have some accounting issues to deal with, and the last question will be an ethical question where you'll be given 2 professional marks will be given. Right? It's a long time after uploading lectures that I've been doing a question. I stopped in question 18 very recently. I think it was a few days back. After that, I didn't do a question for a very long time. So now I have almost covered all the standards. I think I'm just left with 3 standards. Continuation of IFRS 9, IS 28. All the group accounting standards I'm left with. IS 28, IFRS 3 and IFRS 10. So that I'll be covering soon by this week. And now I can fully concentrate on revision kit. Okay, so let us start background. You have been given the extracts of the statement of financial position of Fiskerton for 30th September 2008. Okay, you have some Hallam property, then you have the sales contract. That means there will always be more than one accounting issues asked in question number 2. Okay, so if you see, there are 3 requirements. A, discuss how the Hallam property should have been accounted for and explain the implications for the financial statements and the debt covenant. One is the implications on the financial statements, the other one is the debt covenant. Okay, whenever they ask these questions, by now when you if you have done a revision kit questions, if you have done so many revision kit questions, not just one, you must have seen a pattern that they always ask this: the implications for the financial statements, explain the implications. What does it mean? What are they actually telling you? Implications for the financial statements, those items which can have an impact on a statement of profit and loss. For example, if something is recognized or something needs to be de-recognized on your statement of financial position. So if any item, definitely this item will have an impact on both of those places. So if it has impact on your profit and loss account as well as your statement of financial position, that is known as implications, right? These implications could be positive or negative, right? And the debt covenant. What would happen to the debt covenant? Will it be breaching? Will it not? So all those things you need to discuss in A. Related to the Hallam property. That means Hallam property, if you recognize, what happens in your statement of profit and loss? Whether your expenses goes up, whether it's a profit goes up, and if it's in the statement of financial position, that means what is it? Is your asset going up? Is your liability increasing? Is it your equity which is being affected? For 7 marks. Coming to part B. So in accordance with IFRS 15, clearly they told you the standard IFRS 15. Discuss whether revenue arising from the sales contract should be recognized on a stage of completion basis. On a stage of completion basis, when do we use it? When revenue we need to recognize over a period of time, not at a point in time. That's when this comes. Stage of completion basis, 4 marks. Okay, please understand the question. This does not mean that you are going to apply all the 5 steps to recognize revenue. That's not what the question asked. Okay, and part C, ethical question, mostly it is 7 marks and 2 marks are your professional marks. Explain any ethical issues which may arise for the managing director and the accountant from each of the scenarios. That means you have to relate this to A and B. Always ethical issues, I always say answer at the end, because it's helpful that you can use the accounting issues of A and B to answer your ethical issues. You can link it and get more points. So we are going to start with A. Always read your requirements before you attempt the question. It tells you that when you go through the case study, you know what you're actually looking for because you have read the requirements. Okay, and you know that part A is only for the Hallam property, so you can spread out. You don't have to do the whole case study. You know that the Hallam property, that means this paragraph and this one is just for your requirement A. So you only need to read this much. Next one, sales contract. This is for your part B. It is not related. Even if it is related, they always make sure in SBR that part A and B they are like this, separate issues. Even if the company is same or anything, the issues are separate to each other. For example, Hallam property. Okay, the issue with it will not affect your revenue recognition. It will not have any impact on it. So they separate it out like that. Okay. And then the ethical issue you need to write throughout the whole case study. You will find out ethical issue in A also, in B also, and some extra issues also you will find out. If we have any separate paragraph for ethical issue, but here we don't have. We only have two. One is sales contract, one is Halam property. So now we are going to read the Halam property. Okay, the bank loan has a covenant attached whereby it will become immediately repayable should the gearing exceed 50%. Okay, they have a negative cash balance at 30th September 2008. Okay, Halam property included within the non-current assets of Fiskerton is a property in Halam which have been leased to Enningley under a 40-year lease. What is it? Lease under a 40-year lease. The property was acquired for 20 million on 1st of October 2007, a year before that, and was immediately leased to Enningley. So this was acquired for 20 million. This is the cost. The asset was expected to have a useful life of 40 years at the date of the acquisition and have a minimal residual value. Fiskerton has classified the building as an investment property and adopted the fair value model. Okay. Now, the property was initially revalued at 22 million on 31st March 2008. Interim financial statements have indicated that gearing was 55%. This is interim. That means you are making maybe quarterly or maybe half, okay, after 6 months, not annually. According to that, you have breached the gearing because you are supposed to have 50%. More than that, you are breaching the loan, breaching the debt covenant. But here the gearing is 51%. Prior to this revaluation, that means before this revaluation, it's 51% already. The managing director was made aware of this breach. You see? So this is an ethical issue of yours. Always when you're seeing in your case study, when you're looking for points, okay, when you're reading, always keep your mind open. Think from the ethical point of view. If just ask this question, does it have any ethical impact? If something is unethical, or you can see that you can write this in your ethics part C, always highlight it, underline it, and keep it. So one is that they are aware of the breach of the covenant, and so instructed that the property should be revalued. The property is now carried at a value of 28 million, which was determined by a sale of, how they got this 28 million, which was determined by a sale of a similar size property on 30th September 2008. The property was located in much more prosperous area and built with a higher grade of material. An independent professional valuer has estimated the value to be no more than 22 million. You see, what are they doing here? They are valuing more than it should be. And the managing director has argued that fair value should be referenced to an active market. So this is another ethical issue. And is refusing to adjust the finance. First of all, they are aware of it. Next, they are not adjusting. Okay, they are refusing to adjust the financial statements, even when he knows it is contrary to the IFRS, International Financial Reporting Standards. Right? So you have to discuss whether it should be under investment property. If so, then which fair value should be used. All those things you have to explain in part A. So let us go through that. Okay. So you need to see, whenever they give an accounting issue, they will not just give you where you only have to apply one standard. They will give you a scenario where you have to use more than one accounting standard. So you have to be very aware what are the standards. Number one is leases, IFRS 16 leases, because they have talked about leases. Okay. So according to IFRS 16 leases, the lease is a finance lease. Okay, this is another question to ask. A very good question you might ask. How do you know whether this is we are applying the lessor accounting or lease from the lessee accounting, lessee's point of view? For that you need to read this again. Who is giving lease to whom? Okay, just Fiskerton. Okay, which has been leased to Edingley. So Fiskerton, we are reporting from his point of view. We are reporting the Fiskerton's financial statement. So he's a lessor. He's a he's a lessor. He is leasing. Okay, F is leasing to Eddingly. So he is the lessor, he is the lessee. Okay. So when it is lessor, we have to classify it into two: finance lease or operating lease. So you need to see whether it is a finance lease or an operating lease. So how do you know that there are some criteria which will help you to decide whether it's a finance lease or an operating lease. Okay. For example, you will see whether the asset was transferred at the end to the Eddingly, right? So if you see this was acquired and was immediately leased, okay? And also, if you see that the lease term was 40 years and asset was expected to have a useful life of 40 years, the whole year. So majority of the asset's life was under lease. So this is also one area which says that this is a finance lease. Okay. So now we'll read the answer. So this lease is a finance lease. Without wasting time, immediately you have to write this. You need to classify under IFRS 16, what is it? The lease is a, basically you have to classify the lease. If it is from the lessee's point of view, you have to recognize what? Right of use asset and lease liability. But this is a lessor. So it's about operating or finance. So this is a finance lease. Why is it a finance lease? Now you give reasons. So in SBR, you have to apply this technique to write answers, to write, I'm not saying for the calculation, but calculation you will do it. But when you're writing answers, descriptive answers, you first need to identify, let me write, identify the standard. Okay, I think it's better I write down the points for you people to go through, because this every time you have to follow this pattern. If you follow this pattern, you can never go wrong. Trust me. The only area that you have to work out is on your knowledge part. That you have to do it by yourself. But what I can teach you is how to answer it, the approach of answering it. And this same technique you can use in your other papers also, not just SBR, even your account audit you can use, your triple A. Because they are also same thing. We need to apply standards only. Okay, so let me write the process of writing answers. So number one, you identify the correct standard. In this case, it is IFRS 16. Definitely, there are more than one standard, but first standard you need to write is about the lease, how it should be classified under lease. Number two, classification. That means according to the standard you classify. Like for example, here it is finance lease. So classification into category, because everything has a category. If it is IFRS 9, whether it's financial asset, if it is IFRS 16, whether it's a finance lease or operating lease, right? Every standard has some classification to categorize. This is under this is under this is under this. Number three, the reasons. Okay, reasons for choosing the above category. Why it is a finance lease. So now you are giving reasons for the finance lease. You see, everything you're writing in one line, you are not wasting too much of time. Okay, describing all the 5 points. If this happens, then it's a finance lease. So this five needs to be happen. No, you're not writing all those 5 points, which we used to say that okay, if these are there, then it's a finance lease. No, whatever the points you can use from the case study, only those points. For example, we can talk about the useful life because it's given. Useful life of the asset as well as the lease term, both are 40 years. So this is because the lease term, you see, lease term is equal to the useful life, both are 40 years. And residual value is deemed to be minimal. That means very small. So as such, the property should not be held as an investment property. Now, it is not okay to say only a finance lease. You need to clear this doubt whether it should be held as an investment property or not, because they have held it under an investment property. So if they are right, you can say okay, it can be held as an investment property. If they are wrong, you need to say they cannot be held under that investment property. So the next one is the property should not be held as an investment property. But instead, if if they should not be held as an investment property, then what? Then de-recognize it. Then it must be de-recognized. So fair value of the gain of 8 million must be reversed. That means you have already recognized a fair value gain on this property. Now you need to reverse it. Fiskerton, you have to use the name of the company. Should record a lease receivable equal to the net investment in the lease. Remember, under IFRS 16, it's a finance lease. Okay. So now what should they recognize? Fiskerton should record a lease receivable. They are getting they are going to get the amount from the lessee, Eddingly, right? Eddingly has to pay Fiskerton for that lease. So for lease is a receivable. So Fiskerton should record a lease receivable. And what is that amount of lease receivable? Equal to the net investment in the lease. Whatever their net investment in that lease, up to that much amount they will be receiving. They have not yet received. They are going to receive it in the future. Lease receivable. How we normally record debtors, right? Receivable when we sell our goods on credit, we write a receivable in a statement of financial position. Same way, under a lease, we need to recognize a lease receivable. And that lease receivable is equal to the net investment in the lease. Okay. Now, so tutorial note is, you don't have to write the tutorial note. It is just for understanding purposes. They told if lease was an operating lease, then the property should have been presented as an investment property if it was an operating lease. Because investment property, why you didn't recognize as an investment property? Because it's a finance lease. Finance lease means risk and rewards. The ownership of that asset you are transferring to the lessee. Lessee is the one who is having. So Fisker cannot recognize that as an investment property in that. But if the lease was an operating lease, who is holding, who is controlling the asset? Who is having the control over the asset? It is the Fiskerton, right? So then he can recognize the investment property. So it should have been presented as an investment property if it was an operating lease. Rental income would be recognized in P&L. Okay. This is just for understanding purpose. Note that when the fair value gains were incorrectly calculated, so the fair value gains were also incorrectly calculated. Since adjustments should have been made for the difference between the Hallam building and the one sold due to the different location and the quality of the materials between the two buildings. You should make the adjustments when there are differences between the Hallam building and the one sold due to the different location and the quality. Remember, two things were different. One is they were making it a supreme, they were selling at a supreme location as well as quality. The material that we're using are superior to Fiskerton. So you need to adjust that difference. You cannot take same as it is for Hallam's. So that's why that fair value gain is incorrectly calculated. You have to make mention of IFRS 13 because fair value. Okay, so definition of fair value is given. Okay, when deciding on a sale or the purchase price, when you have to decide on a price, participants should factor in the condition and location of an asset. You have to adjust for these things in the price. What is your condition and where is the location? Where is your location and what is the condition of your asset? You just cannot take it same what is given in the market. Because they are making in a supreme location, they are having a better quality materials they are using in their building. So definitely their price will be higher. Their fair value. You cannot take exactly that same fair value and put it in your one. You need to adjust that fair value in your one. Then you're taking that fair value. Okay. So a more accurate reflection of the fair value would have been 22 million. Now let me go to the case study and show you this. Remember the independent expert. They have valued it as 22 million. The independent professional valuer 22 million. It should not be more than 22 million, but they have carried it at 28 million, which is very high for them. What is the impact on the financial statements? Okay, so we have done, now we have clearly told, okay, we have corrected. The first part, what did we do? We correct. Whatever the wrong things we told, derecognize, now put it in the correct place. And also the amount we told. Now we are going to show the impact on the financial statements. You need to put a separate subheading like this when you're writing impact on financial statements. Okay, easy marks are available for recalculating. Now you might have to recalculate your gearing ratios, because there were some mistakes, some errors which you have corrected, right? So don't get scared by seeing this big answer. Okay, we are going to go into it and see how to build up the points. Okay, so we are first going to start with the incorrect treatment. What happens when it's the incorrect treatment we are using? So the incorrect treatment has enabled Fiskerton to remain within its debt covenant limit, number one. Okay, by using the incorrect treatment, what was the gearing ratio? It was 51%, just slightly above 50%. Okay, 50% was the limit, but they were, according to interim financial reports, it was 51%, which was slightly 1%, but that does not matter so much, because the difference is not so material. So that means they are remaining within the debt covenant if they are following the incorrect treatment. You always start with the incorrect treatment, then you go towards the correct treatment. Okay, apply this approach when you are answering, especially the impact on financial statements. Gearing per the financial extracts is currently around, but if you go by the gearing, okay, it is currently around 49.8%, and according to the interim it is 51%, 49.8%. So this is how you need to show it. Okay, let us go to the financial extracts. That's debt over debt plus. So what is your debt? You have to take your non-current liabilities. Don't take your current liabilities. Only long current liabilities comes in your debt. So debt divided by debt plus equity. So in the denominator will be 50,000 plus your this thing equity plus your other components of equity and your retained earnings. These three will be added in the equity section. Okay, if you see, that's what they have done here. Yes. So, okay, they are not taking the 50. They are not adding debt again. It's debt over equity they are taking. Sometimes you can take gearing as debt divided by debt plus equity also. So any of this you can take. Okay, here they have taken the second one. Sorry, the first one. So it is, according to that, is 49.8%. It's below 50%. That means they are within the limit. So the fair value gains on investment property were reported within profit or loss. You see the gain on investment property. They were reported within profit or loss. Retained earnings were consequently be restated to this amount. So because of that, it will be restated to, this was your retained earnings from your statement of financial position minus 8 million. You need to take it out from your, that 8 million gain. It is incorrectly recorded. You need to take it out from your retained earnings because it was there, no profit or loss. So minus 8. So this would be your retained earnings now, 62.253, not 70.253. Now you are correcting the figures. Gearing would consequently become, so now the gearing will become 54.1%. Okay, everything remains same except this retained earnings that changed, and because that changed, that reduced, your gearing went up. Furthermore, retained earnings, so you are adjusting one by one figure. This is how you need to write answer. First you talked about, first you calculated gearing according to the incorrect figure. Next, you took out the fair value gain from the retained earnings. Third, now you have calculated again the gearing with that retained earnings, new retained earnings. So furthermore, retained earnings would be further reduced by correcting for rental receipt. So when you correct for the rental receipt, again retained earnings would be adjusted. It would be reduced more. this presumably have been included in, so this was included in profit or loss. It's a presumption that that gain would have recognized in profit and loss. So rather than deducting, so it was a gain, so now it needs to be deducted from that. Rather than deducted from the net investment in the lease. So it should have been deducted from where? Net investment in the lease. This would in part be offset by interest income. So this will be offsetted by the interest income, which should be recorded in profit or loss at the effective rate of interest. Okay. Remember, when for your lease, okay, interest income also you need to recognize, which will go in the profit and loss. At what rate? Effective rate of interest. Now, so after correcting for this error, you're finally giving them a conclusion. You're talking about the debt covenant. Now you have to talk about the debt covenant, whether they are breaching it or not. So after the correcting for this error, Fiskerton would be in the breach of his debt covenant. Right? In the beginning, you told that they have a negative cash balance. Okay? It's given there that they have a negative cash balance and would appear unlikely to be able to repay the loan because negative cash flow and also they are breaching the debt covenant. So it's very unlikely that they can repay the loan anytime soon. So serious consideration should therefore be given as to whether Fiskerton is going concern or not. If it is determined that Fiskerton, so mostly you can talk about going concern when you can see that you are breaching the debt covenant and also you have a negative cash balance. So in the future answer you can talk about going concern issue. Definitely it's a going concern issue, right? If you are unable to pay the debt. If it is determined that Fiskerton is not a going concern, then what? Then non-current assets and non-current liabilities should be reclassified to current and recorded at their realizable value. Okay. So according to IS1, going concern uncertainties must be disclosed in the financial statements. Okay. But if Fiskerton can renegotiate with the bank, then the uncertainties surrounding their ability to continue to trade must be disclosed. You have to write this. When you have raised in your answer about going concern issue, remember, if it is proven that there is going to be a going concern issue, you need to disclose it. Okay. If you are uncertain also, uncertainties are there, whether you can continue in the future or not, you need to disclose it. So that's what for your first requirement. Now let us go to the second requirement where we are going to talk about IFRS 15. Fiskerton has entered, see, if you see it's the same company, right? But it is not related to part A, so you don't have to worry at all. You can even answer part B before answering part A. Fiskerton has entered into a sales contract for the construction of an asset with a customer whereby the customer pays an initial deposit. The deposit is refundable only if Fiskerton fails to complete the construction of an asset. Then only they will give that deposit back to the customer. The remainder is payable on delivery of the asset if the customer defaults on the contract prior to completion. Fiskerton has a right to retain the deposit. The managing director believes that as completion of the asset is performed over time, revenue should be recognized accordingly. He has persuaded the accountant also. What did he do? Persuaded the accountant. This is an ethical issue. He has persuaded the accountant to include the deposit and the percentage of the remaining balance for construction work in revenue to date. So now we'll see. Let us go to part B. You see, do not simply recite the 5 steps of the revenue recognition because a lot of it is irrelevant. It's not relevant. They just asked you about the timing of the revenue recognition. That means only the 5th step is relevant in this case. Okay, so that means what should you know? You should know the criteria for recognizing revenue over time. And it's just for 4 marks. Okay, so don't waste your time writing too much on this. So according to IFRS 15, here also you are referring to the standard. It's already given, so it becomes more easy for you to know. And here it's just one standard only. It's for 4 marks, so they will not ask you too many standards. It's just IFRS 15. So according to IFRS 15, at the inception, that means at the start of the contract, Fiskerton must determine whether his promise to construct the asset is a performance obligation satisfied over time or not. This was the fifth condition. I mean, in the fifth step, this is a condition when you have to recognize revenue over time. That performance obligation, are you satisfying it at a point in time or over a time? Are you promising that the asset you are giving over a period of time, or you are giving the asset at a point in time to your customer? What did you promise initially at the start of the contract? According to IFRS 15, you must see that. Next, during the production of the asset, Fiskerton only has the right to the initial deposit when you are producing the asset and has no enforceable right to the remaining balance as construction takes place. So when construction takes place, you cannot tell that I am eligible for the remaining balance. No, you don't have the right. Only the initial deposit you can take it. Therefore, Fiskerton would not be able to recognize payment for work performance to date. So they will not be able to receive the payment for the work performed to date. That they have to wait until the completion. Before that, they will not receive the payment. As such, revenue should not be recognized over time, but at a point in time. At a point in time is when the control passes to the customer. Mostly for goods and all, it's at a point in time because you are giving the good at a specific date. Let's say I'm selling my computer on a contract to a customer. I know that at this date I will be selling and I'll be receiving cash. So I recognize my revenue the day when I'm selling it to the customer. But for services and all, it's usually over the time. Okay, so here it is decided that it is not over a time, at a point in time when the control. So whenever you say that it's at a point in time, remember to mention this also, that control should pass to the customer. Most likely when the control will be passed on the delivery of the asset to the customer. So that's it. It's just for 4 marks. If you write 4 points, you will get the marks. Now we are going to the ethical questions. Ethical questions you are free to write in any way. There is no standard framework to follow for writing ethical answers. It's like an open-ended question. We don't have to refer to any standards. Okay, so you can take the help of A and B. Now we know what are the accounting issues. So let us just go through the answer. So first we can start about the property being classified as an investment property incorrectly. So we can start by from that point. So it is concerning that the property has been incorrectly classified as an investment property. So you start from here. You can start from anywhere. Revenue recognition or this or that. It does not matter. But what I suggest is always start from the beginning of your case study, the way it is given. It's easier that way. Okay. So property has been incorrectly classified, number 1. That's the first requirement. Has been incorrectly classified as an investment property. So accountants have an ethical duty to the professional to be professionally competent and act with due care and attention. So out of the 5 ethical principles, these are 2. According to this case that you need to follow. One is you need to be professionally competent and you have to act with due care and attentions. Okay. When it comes to classification of property, it is fundamental that the financial statements comply with the accounting standards and principles which underpin them. This may be a genuine mistake, but even so would not be one expected from a professionally qualified accountant, right? So you can say that this could be a mistake made. Mistakenly, maybe they have incorrectly wrote in the investment property. They have no intentions to do it. But even then, even if it's a mistake, as a professionally qualified accountant, you are not supposed to do that mistake. So in your ethical answers, you need to write these things. Because no mistake is taken for granted. You cannot take a mistake for granted. You cannot say, okay, it's a mistake, next time I will not do. No, you're not supposed to make that mistake. Because you are a professionally qualified accountant. You're supposed to be someone who is professionally competent enough. So the financial statements must comply with the fair presentation principles embedded within IS 1. That means presentation has to be fair, okay? Outline the specific ethical principles that have been breached. So wherever the ethic, you have to be very specific. Out of the 5, confidentiality, objectivity, integrity, professional competence, and due care and professional behavior. Not all 5 are breached in this case. Whatever it is breached, only be specific to that. So here, the managing director appears to be happy to manipulate. You see, they are happy to manipulate. You will get points to write this points, whether they are genuinely doing it, or are they being pressurized to do it, or they are happily doing it. So it does not seems like that they are regretting or anything. So managing data, they are happy to manipulate the financial statements. Okay, so this is like a self-interest threat to objectivity. You have to link your threats to your ethical issues. What are the five threats? Self-interest, self-review, familiarity, advocacy, and intimidacy threat. So this is self-interest threat. That means they have their own self-interest, the managing director. Self-interest threat to objectivity. Objectivity, they are not objective. They are not independent. So self-interest threat to objectivity arises from an issue over the debt covenant. Be very specific. When it is related to a specific thing, you have to write specific rather than writing general ethical answers. So this arises from the issue over the debt covenant. It is likely that the managing director is concerned about his job security. So it is very you will get professional marks for writing these things, okay? Because these things are not there in the case study that they are very concerned. But this is something you are writing because they might be worried about jobs and all, right? No one wants to just manipulate financial statements if they don't have any interest. They might be concerned over something. That's why they are doing it. So it is likely that they will be concerned over the job security should the bank recall the debt and deem Fiskerton to be no longer be a going concern. Because if the bank recalls the debt and they deem this one to be no longer a going concern, so they're scared for it. They don't want to be shown as an organization which is not going concern. So that's why they have a very reason to manipulate. That's what according to the managing director, you're writing this answer from his point of view. It appears highly likely that the revaluation was implemented in the interim financial statements to try to maintain a satisfactory gearing ratio. You see, you need to talk about revaluation. They have this was implemented, the revaluation in the interim financial statements, because they want to maintain a satisfactory gearing ratio, which was 51%. I remember. Even more concerning is that the managing director has deliberately overstated the valuation for the year-end financial statements. You see, it was supposed to be 22, according to some independent professional expert, the one who values and all the property, but he has put it at 28. So he has overstated the valuation at the year end, even though he's aware. You need to bring out this point in your answer, whether he's aware or not. So he's aware that this breaches accounting standards. Okay. So such deliberate manipulation is not allowed in the ethical principles of integrity, professional behavior, and objectivity. Out of five, three are affected. What is it? Integrity. They are not honest. Professional behavior, because as a professional, you're not supposed to do it. And objectivity, of course. It appears that the managing director is trying to defraud the bank, right? It looks more like that they are trying to defraud the bank by misrepresenting the liquidity of the business to avoid repayment of the loan. So for writing these things and also actions that you are going to give them, you will get the professional marks. I cannot exactly tell you that for this point only you will get the professional marks, but it is this way only. Okay, so now we are going towards the revenue. Make explicit reference to the impact of the revenue around the financial statements. The sales contract is further evidence that managing director may be attempting to manipulate the financial statements. The proposed treatment will overstate both revenue and assets, which will improve the gearing ratio. Because if your revenue and assets are higher, your gearing ratio will improve. That means gearing ratio will go down less than 50%. Okay. A governance issue arises from the behavior of the, so this is a governance issue. So for writing these points, professional marks we are getting here also. because governance issue is something they have not mentioned in the case study. So governance issue arises from the behavior of the managing director. It is important that no one individual is too powerful and domineering in running an entity's affair. Here where most of the professional marks you will get for writing these points. An intimidation threat arises from managing director. What are they doing? They are pressurizing the accountant. This is known as intimidation threat. To to do what? Overstate revenue from the contract. It was only the managing director who implemented the excessive regulations. But in this case, sorry, it was also the managing director who implemented the excessive revaluation of the property. So it would appear that the managing director is exercising too much of power over the financial statements, you see. Now, outline the specific actions that accountant should take. Always in ethical questions, don't just give ethical issues and finish it off. At the end, you have to write actions. What accountant should do after knowing all this, after being pressurized by the managing director. Every ethical question you have to write. What actions they have to do, accountant should take. So the accountant may not be influenced by the behavior of the managing director and should produce. They must, number one, okay, definitely they should not be influenced by the managing director's behavior. And they should produce financial statements which are transparent and free from bias. This is common to any ethical questions. Any ethical questions you write, you can write the same thing. Instead, the managing director should be reminded of their ethical responsibility. So this is second thing, okay, that you need to remind them. The accountant may need to consider professional advice. This is the next step after reminding the managing director about the ethical responsibilities. Should the managing director refuse to correct the financial statements? So if the director refuses, then what should you do? You should give all this advice. First you have to remind them, then you have to take professional advice. If the managing director is not listening to you, from both you need to give answers. What if the directors listen to you? What if the directors are not listening to you? What should you do then? Okay, so this is your marking guide. How are you getting the 7 marks in part A? Correct treatment of lease, you are getting 3 marks. Okay, the implications for the financial statements 2 marks, implications for the debt covenant 2 marks. So don't forget that each element needs to be answered. What happens sometimes, most of the students, they just show the implications on the financial statements and forget about the implications for the debt covenant. And also the correct accounting treatment of the lease, they don't show it. Part B, consideration whether it is a performance satisfied over time or at a point in time is 3 marks. Only 1 mark for the conclusion. Whether you recognize revenue or you do not recognize revenue, only 1 mark. And C, they will never show you how you will get the 2 professional marks, okay? It's based on the tone you're using, the structure of your answer, what are the actions you are telling them, what are the issues you are bringing out. So the application of the following discussion of ethical issues to the scenario, you're linking it to the part A and part B. What are the one is classification of property as an investment property for 2 marks for that. Revaluation and the manipulation of the debt covenant 3 marks. And 2 marks for consideration of ethical implications and their resolution for the actions and the implications of ethical issues. And we have some examiner's comment for you. So many candidates felt that the investment property classification was justified. They think that it's okay, that it's an investment property. Where a candidate concluded with some justification that this should be an investment property, you will be given some marks. Don't worry, you will not be given 0 marks. Okay, and if you have made some calculations also, reasonable attempt at calculations, you will get marks. Then the own figure rule was used to justify the conclusion reached by the candidate. What is the own figure rule? That means they are reaching the conclusion based on their own calculations. So for that, if let's say for example your calculation is wrong, right, so based on that your conclusion also becomes wrong, you will only be penalized once. They will only cut your marks once when your number is wrong, when you're calculating. They will not cut your marks twice for writing incorrect conclusion because of wrong calculations. Okay, so that's a very good thing, I feel, by the ACCA, that they are not cutting our marks twice. The second part of the question required a discussion to whether revenue from sales content should be recognized over the time or not. Any mention of IFRS 15 in the question seems to prompt a. So when you're writing all the steps of IFRS 15, it is just a pure knowledge. You're not applying it to the case. Okay? When you're writing all the 5 steps, not necessary. It's just for 4 marks. But still, after warning so much, students still do the same mistake. They keep repeating the same mistakes over and over again. They will write always, whenever IFRS 15 is asked, they will always write the 5 steps. I mean, I don't know why they're so hurried to write the 5 steps. Yes, if it is asked, if it's needed, then okay. But they will not ask 5 steps. At least 1 or 2 steps only you need to make use of in your answer out of the 5 steps in any question you see. Okay, so that's it for ethical questions. They didn't give anything. So that's it for part A and part B. And see you in the next question.